Good morning. Welcome and thank you for participating in GIRAF's annual tax planning webinar. My name is Stephen Boisvert and I'm a tax manager at GRF CPAs and Advisors, formerly known as Gelman, Rosenberg and Friedman. I will be today's moderator. I'd like to start off today with some quick housekeeping items and explain what you will need to do to earn CPE credit. Participants seeking CPE credit today must complete and submit a short evaluation survey that will appear automatically immediately following the webinar. You will also be asked to recall these words in order to receive credit. So please write down the CPE words when they are given and keep them until you receive your certificate. They will not be provided again. If you have any technical questions or issues during the webinar, please use the questions function to speak with our webinar administrator for assistance. The slide deck and recording from today's webinar will be available for download at the link shown here, and you will receive a follow-up email with direct links. Technical support and CPE questions may be addressed to Dominic Acosta at dacosta@grfcpa.com. Today's learning objective is to provide attendees with a better understanding of how you should position your assets for the best tax advantage. One CPE credit is available for this webinar. I'd now like to introduce our presenters for today's webinar. David Grayling is a tax partner at GRF CPAs and Advisors. David consults with clients on optimum business structure, tax saving strategies, tax compliance, estate planning, and family-owned business planning. He also has extensive experience with nonprofit organizations, which includes auditing, structuring of nonprofit organizations, internal control evaluation, and management consulting. Troy Turner is a tax partner and director at GRF CPAs and Advisors. Troy oversees the firm's tax department and specializes in providing tax advisory and compliance services for businesses and individuals who have international aspects to their tax situation. I will now turn the presentation over to David.
Thank you, Steve. Good morning, everyone. This is David Grayling. I'm glad we were able to pull you away from the impeachment hearings this morning for a topic that's much more interesting than the impeachment hearings. So just the agenda items we're going to cover this morning. We're going to revisit the Tax Cut and Jobs Act. We're going to discuss itemized deductions, talk about some credit issues. Troy's going to talk about the qualified business income deduction. Then we're going to wrap up with some ways to reduce income. So let's revisit the Tax Cut and Jobs Act. This law was effective January 1st, 2018. It was signed into law by President Trump in late 2017. What it provided was for new tax rates effective 2018 and future years, which includes 19 that we're in now. One issue that you may want to do is check your withholding for 2019, because as we found in 2018, many clients were under withheld for 2018's taxes, and we're assuming the same thing will happen for 19. So we're happy to work with you to do a tax estimate to make sure you're not going to get penalized for underpayment of estimated taxes. One aspect of the new law was that there were new thresholds for the various capital gains rates. There's a rate of 0% for income up. This was on a married joint return, but income up to 80,000, potentially you could pay no capital gains tax. A 15% rate applies to income of 80,000 to 496,000. Then a 20% rate applies to all capital gains above 496,000. I did see a couple returns during 2018 where we had income that was wiped out by itemized deductions, and all the capital gains escaped taxation. So it was very, very interesting scenario. And several times we scratched our heads trying to figure out whether we had an issue with our computer program. Another aspect of the law is it eliminated all personal exemptions. Used to receive an exemption of $4,050 for each personal exemption. That has been eliminated now. The law did allow for a much larger standard deduction. We'll look at those numbers just in a second, but it had a very big impact on tax returns. Out of about 155 million tax returns filed during 2018, 2018, there were 25 million more taxpayers that claimed the standard deduction. So that's about 16% of tax returns filed. In addition to what we're claiming before, 16% more claim the standard deduction. And we saw that among our client base, in that many more of our clients claim the standard deduction during the year. Another major impact of the law that we saw in 18 was that the whole area called miscellaneous itemized deductions got thrown out. So we used to have this whole category of investment fees, accounting fees, employee business expenses that no longer are deductible. So this certainly had a big impact on a lot of the returns that we saw, because many of our clients claim those deductions in prior years. So continuing on the whole standard deduction versus itemized deductions issues, the standard deduction now is $24,400. This is the revised number for 2019. That's for married filing jointly. $18,350 for head of households, and then $12,200 for single individuals. As I mentioned, all personal exemptions have been repealed. So one thing you want to do is review your itemized deductions each year to determine what is your best course of action. Each year stands on its own. So in 2018, you may have claimed a standard deduction. In 2019, you may claim itemized deductions. So just some information about specific itemized deductions. Medical expenses for 2019 have to be more than 10% of your adjusted gross income in order for you to claim. So the 10% is basically your floor. So if your adjusted gross income was $200,000 in 2019, 10% of that would be $20,000. So if your medical is more than $20,000, you could go ahead and claim the amount above the $20,000. The original law threw out medical expenses in its entirety, and I think a lot of senior citizens pointed out that if you're in a nursing home or if you have home health care, your medical expenses could easily exceed this threshold. So that's why it was put back in. A big one that impacted a lot of people was state and local income taxes are capped at $10,000 now. And I'm sure you've read a lot about this or heard a lot about this, but almost our entire client base was impacted by this, because many of our clients have real estate taxes and state and local income taxes that exceed the $10,000 many times over. We are seeing many clients inquire about relocating to states that have no tax, such as Florida, Nevada, Tennessee, Wyoming, and Texas. Those are just 5 of the states that have no income tax. As we've seen in the last couple of weeks, President Trump actually relocated his residence to Florida, so he will escape taxation. He was in New York, which is a very high income tax state. By moving to Florida, he will escape state income taxation on his income. Another area that was impacted is mortgage interest. So mortgage interest, or mortgages prior to December 15, 2017, the mortgage interest cap is interest on a loan of $1 million. That now has been lowered to $750,000. So you may have read that the housing market is really stable right now, and a lot of people that are living in their homes are not moving. I think this is part of the reason why people aren't selling their homes. They don't want to lose that mortgage interest deduction of $1 million. Plus, a lot of people have mortgages that are at the 3.75, 3.5% rate, and they hate to go out and get a new mortgage that's a higher rate. So we're seeing a real stabilization of the housing market right now. Home equity loans are deductible up to $100,000 of mortgage indebtedness, but you have to use that for buying, building, or fixing up your residence. So you still have a small deduction for home equity loans, but it has to be directly related to the home. Some additional itemized deductions. Charitable contributions are still deductible. I probably had 2 dozen clients say to me, I understand that charitable contributions are no longer deductible, but they are still deductible, but you have to be able to itemize your deductions. So if you claim a standard deduction, you're not going to be able to claim itemized deductions for charity. So you have to be able to itemize your deductions to claim that charitable contribution. The way that we've had many of our clients fund or claim the charitable contribution is they put money into a donor advised fund. So they may put like $50,000 in a donor advised fund in 2018 or 2019. They claim the 50,000 they're able to itemize, and in the future year they're not able to itemize because they don't have the charitable contribution. And then the donor advised fund lets them dole out the money that they put into the donor advised fund over several years. And then another thing that happened in the law is that under the old law, your itemized deductions were limited or capped by something called the Pease Amendment, and that was thrown out in the new law. So there's no limitation on what your itemized deductions are. So they're basically unlimited as long as you have itemized deductions. Now moving on to just some other topics. Divorce. The big change in divorce was alimony. Alimony is no longer deductible by the payor, so whoever's paying the alimony cannot deduct it, and the recipient of the alimony or the payee does not have to record the alimony as income. Under prior law, that was just the opposite. The alimony was deductible by the payor, and the alimony was recorded as income by the payee. The major problem there was that the IRS had several million people deducting alimony, but they weren't seeing the same number of people recording it as income. So there was a very big disconnect. So they decided to basically do away with that disconnect by changing the focus of the alimony. There was a change in Roth IRA rules. Under the old prior law, you could make a Roth IRA contribution, and then within 9 months, you could recharacterize that to a traditional IRA contribution. That is no longer available to you. So once you make a Roth IRA contribution now, you're fixed into that, and you cannot recharacterize that as a Roth. You cannot recharacterize that as a traditional IRA contribution. The child tax credit, and we saw many clients take advantage of this in 2018, but that child tax credit increased to $2,000 per qualifying child. Before it was like about $800 under prior law. The nice thing is if you have no income tax at all that you're paying, you can claim this credit and you get $1,400 of that credit as a refund. So even though you pay no tax, you can still get some tax credit money back up to $1,400 per child for that tax credit. Some miscellaneous individual changes that impacted 2018, but it will also impact 2019. If you have a dependent who's not a child, say an elderly parent who lives with you and you provide over half their support, you can claim a $500 credit for that person. So that is available as an additional credit. Under the 529 plans, if you have a 529 plan, you can take up to $10,000 out of that 529 and pay for either elementary or high school education. As a basic tax planning maneuver, a 529 plan is an excellent way to fund college education, but now it's been opened up to both elementary and high school education. And a grandparent can set up a 529 for their grandchildren. So it's an excellent way for a grandparent to fund college education for a grandchild. The funds in the 529 grow tax-free. And if the 529 funds are used for tuition, when the child goes to either elementary, high school, or college, there's no taxation on those funds. So not only are you escaping taxation on the buildup of the funds through investment income, but you're escaping taxation when those funds are finally used. Just a word about state and gift tax exclusions. For 2018, the the gift exclusion amount was raised to 11.18 million. For 2019, that's going to be 11.4 million. So it's quite sizable. Very few estates are subject to estate tax at this point. They may be subject to state taxes, but at the federal level, there's no estate tax up to the 11.4 million for 2019. The big problem here is that higher exemption sunsets or gets reduced back down to the $3 million, approximately $3 million level in 2025. So we'll have to see what Congress does with this limitation as we move closer to the 2025 expiration. The other point is for 2019, there's a $15,000 annual gift tax or a gift exclusion. So you can give basically anyone you want up to $15,000 and it escapes any type of gift tax filing. And a husband and wife can give $30,000 combined to anyone that they want. So we've given you the income tax rates for individuals for 2019. You can see we've got single, head of household, married filing joint, and married filing separately. The brackets start as low as 0. There's basically 7 brackets. The highest bracket being 37%, down to the old bracket, highest bracket was 39.6%. And the highest bracket, if you're single, starts at 510,000, taxable income of 510,000. And for married filing joint individuals, it's 612,000.
All right, we've come to our first polling question. Which statement best describes where you currently stand with your 2019 tax planning? A, I have already done my planning for 2019. B, I am interested in planning, but I have not yet begun the process. And C, I do not plan on doing any planning this year. Please take a moment to answer that now. And while participants are submitting their answers, I'll provide the first CPE word. First CPE word is credit. If you want to receive CPE credit, please jot these words down because you will need them for the survey at the end of the webinar. Again, the first CPE word is credit, C-R-E-D-I-T. Back to you guys.
We're just waiting for the polling results to pop up here. Oh, I've got them in front of me. So 43% of you said, I have already done my planning for 2019. Hooray for you. 36%, I am interested in planning, but I have not begun the process. And 21%, I do not plan on doing any planning this year. So those of you, 36% who have not begun the process yet, we're happy to talk to you if you have questions for us about the planning for 2019. So now I'm going to turn the program over to Troy Turner.
Thank you, David, and thank you everyone for attending the webinar today. So I'm going to start off by covering some topics that are also part of the new tax law, and some of them are fairly complex, so it just felt like it was good to revisit them to make sure everybody was, and also make sure everybody was taking advantage of them. So the first one we want to discuss is the qualified business income deduction. So with the new tax law that, again, as David mentioned, went into effect in 2018, lowered corporate tax rates from a maximum of 35% down to 21%. So to provide a benefit to non-corporate business taxpayers, they introduced this qualified business income deduction for those who are self-employed or who have flow-through business income that gets taxed on their personal return. So they got some sort of break as well. So that was kind of the point of the qualified business income deduction. So again, it's taken on your personal tax return. And generally, in order to have the deduction, you'd generally have income from one of the sources listed here on the screen. So you're a sole proprietor filing Schedule C, You have K1 from a partnership or an LLC or an S Corp. Maybe you have a rental property that generates income. An important thing to note here is that if you are getting your trade or business income from a K1, from a partnership LLC or an S Corp, that those entities must provide the required information on the K1 in order for you to be able to take the deduction. So the deduction itself is the lesser of 20% of your qualified business income or 20% of taxable income after removing capital gains and losses. So if you have qualified business income and your taxable income is below the thresholds listed on the next line, so married filing joint of $321,400 or on another return that's $160,700. So if your taxable income is below that threshold and you have qualified business income, then you're eligible to take this new 20% deduction. So some new information that came out related to rental real estate, because there's a lot of rental real estate can either be a trade or business or be considered more of a passive investment activity. And it depends on how the taxpayer, how involved the taxpayer is in the rental activity and how they view it. So the IRS came out with some regulations and some guidance that kind of help people determine whether or not their rental activity would qualify for this new qualified business income deduction. So it does qualify if the activity meets the old rules under Section 162, which just basically meets the general qualifications of a trade or business. They came out with a safe harbor, which under the safe harbor, there's some other nuances, but generally speaking, if you spend 250 hours working in the rental activity during the year, then it meets the qualifications as a trade or business, and you can take the qualified business income deduction. There's some other requirements, but generally speaking, it's the 250 hours is the threshold, and that's something that came out this year to provide some clarity. And if it's a self-rental, meaning if you have another business and you own the office building that your business operates in, and you rent it back to the business, then that's considered a self-rental, and in that circumstance, the income from the self-rental activity is qualified business income. Some other new items related to the QBI deduction is last year in 2018, all we had to deal with were some schedules to do the calculation as to whether or not someone qualified and what the amount was of the deduction. So starting in 2019, the IRS has come out with an actual form 8995 and 8995-A that will be filed with your return that reports this information. Also, I want to point out that the IRS does have a FAQ on their website, and I've got the link here you can go to. So if you have any other questions related to the QBI deduction after this presentation, I recommend going to the FAQ, and maybe that will answer your questions, or certainly feel free to reach out to myself or someone else in the tax department. They'd be happy to help out. So other than the income limit that we discussed earlier, there is further restrictions on being able to take the qualified business income deduction, and that relates to a specified service business. So if you are a specified service business and your income is above the thresholds on the prior slide, the 160,000 and 321,000, then you begin to lose the benefit of the deduction, your ability to take it, and that ability to take the deduction phases out so if you're a single person and you're dealing with a $160,000 threshold, and you have a specified service business, then your ability to take the deduction phases out over the next 50,000 of income, so from 160 to 210. And if you're filing a joint return and you have a specified service business, then your ability to take the deduction phases out between, you have a $100,000 phase out range, so from 321 to 421, your ability to take the deduction phases out. And once you're above the 210 or the 421, and if you have a specified service business, then you can no longer take the deduction at all. So it's very important because of that to understand whether or not you have a specified service business or not. So the slide here indicates all the different types of businesses that are specified service businesses. So I won't read them out, but those are the ones that if you're working in these fields, then you cannot take the qualified business income deduction if you're above the income thresholds. But I do want to point out that, the definition for consulting, because it's very generic, and we get a lot of questions as to whether or not, is my business, am I doing consulting, am I not doing consulting? So in the bottom of the slide there is a definition straight out of the regulations that came out in 2019 to define what the IRS considers a consulting business. So I'll just read the first line. Consulting is considered the provision of professional advice and counsel to clients to assist the client in achieving goals and solving problems. So again, it's a little bit of a gray area, and you can read the rest of the definition on your own. So if you need some help trying to determine whether or not you are consulting or you're not, we're happy to provide some additional advice there. But that's the general definition that the IRS looks at. Also want to point out that you're not a specified service if you're an architect or engineer or a real estate agent or insurance agent. Those were specifically carved out of the specified service business definition. So some other restrictions here. So if you're not a specified service business and you're above, again, if you're above the income thresholds, because if you're below them, you don't have to worry about any further restrictions on taking the deduction. So for those who are not specified service and above the income thresholds on your return, then there's an additional restriction here related to wages that are paid by the business or assets held by the business. So the deduction, first, again, it's 20% of taxable income or the qualified business income, whichever is lower. And then if you're above the income thresholds, you have a further restriction of 50% of W-2 wages. So for example, if your qualified business income is say 200,000, but 50% of the wages paid by the business is only 100,000, then your qualified business income deduction is only going to be 100,000. Or I should point out that if you have 200,000 of qualified business income, your deduction is 20% of that, so that's 40,000. And if your 50% of wages is 100, then you're going to be at 40. If 50% of wages is less than 40, then your limitation is whatever that 50% of the wage number is. So, or if 25% of wages, and if you're a business that's heavily capitalized, has a lot of fixed assets, so if 25% of wages plus 2.5% of unadjusted basis of your fixed assets is higher than your 50% wage number, then you can use that as the further limitation amount. And again, if you're getting a K-1, this is why it's important that the preparer who's preparing the K-1 provides all of this information to you so that your preparer has it. And this is the kind of information that would show up in certain boxes of your K-1, and you'd be able to just utilize the information directly from there related to these restrictions. If you're filing Schedule C or doing a rental property and having QBI from that, then you'd have to figure out the limitations directly on your own. But so again, I've listed the income limitations here in the phase-out ranges, 321 to 421, and married filing joint, and 160 to 210 for other returns. And if you're in a situation where you're dealing with a wage limitation, the business entity has to file their wage reports in a timely manner in order to be able to utilize the wages properly for purposes of calculating this deduction. Some other considerations related to the qualified business income deduction. So if you're an S corp, then the shareholder compensation reduces your qualified business income because it reduces the net income that flows through on your K1, which is the income amount we're looking at particularly to start the calculation. So S corp comp reduces that to the extent the S corp compensation to the officers or to the shareholders is increased. So you want to, in that sense, you don't want to have too high of W-2 wages to the owner because you're lowering your QBI, but at the same time, you need to pay yourself reasonable compensation because the IRS is looking at that. It always has for S corp owners. So basically, generally the best case scenario is that you are on the lower end of reasonable comp for your owner W-2 amounts so that you're maximizing your qualified business income deduction potential. Another thing I want to point out, if you have a partnership that's allocating qualified business income to you on a K1 and you work at that partnership, if you're getting guaranteed payments before, the guaranteed payments are not qualified business income, so you may want to revise your partnership agreement so that you take income distributions rather than guaranteed payments. Therefore, the income amount that flows out on your K1 on line 1 of ordinary income would be higher and guaranteed payments would be lower, and that would increase your potential QBI deduction because, again, the guaranteed payment amount you're getting is not QBI. There was a special carve-out that was created for real estate investment trust dividends and public PTP is publicly traded partnership income. So those are separate categories of qualified business income where you can get a deduction separate from your other qualified business income. I want to point out that QBI does not include foreign income. So again, if you're getting it on a K1, the numbers reported to you on a K1 should already factor in, should only report your US-based income amounts. But if you're doing it on your own, then you have to determine how much of your income is US-based versus foreign because the foreign income does not qualify. Qualified business income is calculated on a per business basis and then it's aggregated. So each individual business has to run through this calculation relative to wage limitations and asset value limitations and income limitations to figure out what your potential deduction is per business, and then you aggregate them together to come up with your actual deductions on your return. And here we're thankful for computer software. And if you have a overall qualified business loss, then that loss carries over to the next year.
All right, we've now come to our second polling question of the day. Do you expect to utilize the new QBID on your 2019 tax return? A, yes, I have already factored it into my tax planning. B, how do I find out if I qualify? C, I do not expect to utilize the deduction. And please take a moment now to answer that. While participants are submitting their answers, I'll provide the second CPE word, which is tax, T-A-X. If you would like to receive CPE credit, please jot these words down and use them at the survey directly following the webinar. Again, the second CPE word is tax.
Okay, great. So I've got the polling results here, and it looks like 18% have already factored the deduction into their planning. About 10% want to find out if they can qualify, and please reach out to us. We'd be happy to help you with that. And then about 73% of people don't expect to utilize the deduction this year. So again, for those who are expecting to take it and those who are interested and think they may be able to take it, it is very important to figure that out because it can have a big impact one way or the other, whether you're expecting it and don't get it, or whether you haven't factored it in and could possibly benefit from it. All right, so the next topic I want to cover are loss rules, business loss rules. These also came into effect in 2018 and did affect some of our clients, although maybe not on a broad basis, because the numbers here are fairly large, but it did affect a handful of our clients. So we wanted to bring this up again and remind people that if your collective amount of business losses before those business losses, if they met the other limitations that are listed here, you had basis, you were at risk, and you either had passive income to offset them, or it was not a passive activity, it was an active trade or business. So if you already jumped through these 3 hoops that were already in the law, then before, if there was no limitation on your ability to deduct business losses against your other income, against your investment income, interest, dividends, capital gains, wages, rental income, so on and so forth, you could deduct your trade or business losses against all that income without any further limitation, as long as you met those first 3 requirements there that are not highlighted. But now under the new law, your ability to deduct those trade or business losses against that other income is now limited to $250,000 annually for all other returns, so single, head of household, married filing separate, and if it's a joint return, the limitation is $500,000. If you have losses in excess of those limits, then those losses carry forward and can offset other income, whether it be trade or business income first, and then against your wages or investment income second, up to those same limitations in future years. So you don't lose the benefit of the loss if you can't take it all in 2019, but you can take it in a future year. So it's good to factor in any carryover losses from 18 into 19's planning, or if you have a big loss this year that's kind of an anomaly, make sure you realize that you are limited to those limits and your ability to deduct that loss against other income. So we have just kind of a simple example here under old law. If you taxpayer married filing joint with $2 million in other income and $750,000 business loss, they could deduct the whole thing under old law. Under new law, they're limited to $500,000, with the balance carrying over, the $250,000 loss balance being carried over to be used in a future year against other income. I want to point out here that wages is considered business income, and 1231 gains, which are generally business gains, are considered business income for the purpose of this limitation. So that's a good thing to work into your planning. Another thing I want to point out is bonus depreciation, and we'll get into 179 on the next page, but basically the new tax law that went into effect in 18, it also, you'll see here from the end of 17 through 2022, you have the ability to deduct 100% of the cost of fixed assets, and there's certain fixed asset classes that are listed on the slide there, the asset classes 3 through 20. So basically, if you buy any of those in 2019, or you're looking to buy them before year end, you can deduct 100% of the cost of those assets as a deduction versus having to depreciate them over their useful life. So we've had some version of bonus depreciation in the law for a number of years now. It's fluctuated between 50% or 100%, but the new law that went into place in 2018 basically set up this chart here where it's 100% through 2022, and then you see where it's 23, 4, 5, and 6. Bonus depreciation then kind of ratchets down all the way to 20%. But for 2019, and if you need new equipment, you can buy it and deduct the full cost on your return. So 179, again, has been in the law for a long time. It's at various thresholds where you could elect to expense fixed assets that were purchased. I think when the law first came in, it was a $25,000 threshold, so it wasn't a big deal. It's gone up and down over the years. So the new law in 2018 created $1 million threshold, so you could write off up to $1 million of property as long as you didn't buy more than $2.5 million worth of property, and then that your ability to take 179 got phased out, as your total purchases went above $2.5 million. The 2019 amounts have, been indexed up slightly to $1,020,000, and then phase out starts at $2,550,000. So you can see the old law amounts prior to 2018. It was $500K was the ceiling on 179. Again, this is similar to bonus depreciation where you're buying new fixed assets. The definition of the qualifying property is a little different. So you may have something that would fit bonus better than 179. One thing about 179 is you can't take it if you have a loss. If you elect 179 and have a loss from the business, then that deduction will just be carryover to be taken in a year when the business has income, whereas bonus depreciation, if taken, can increase your loss. So generally, I find that most clients just end up taking bonus over 179 in most circumstances. Some other 2018 law changes that I want to just remind everyone about. Again, I mentioned this earlier, but the corporate tax rate is now a flat 21%. So that started in 2018. Again, it used to be a high of 35% prior to that. Net operating losses, carry forwards. Under the old law, it used to be if you had a net operating loss in 1 year, it would automatically carry back 2 years and then carry forward 20 to be able to offset income in those other years. So if you had a loss and you had paid tax in 2 prior years, you could immediately go back and get some of that tax money back. Now under the new law, you can't carry NOLs back any longer, and they only carry forward, but they carry forward indefinitely rather than having a 20-year limitation. But there's also a limit, whereas under the old law, you could use as much NOL carry forward as you needed to offset your taxable income. Now it's limited to 80%. So if you have an NOL that's generated in 2018, you can only use, offset income up to 80% of income going forward. So you could only use a 2018 NOL to offset up to 80% of your 2019 income. So keep that in mind. If you had a big loss in 18 and you thought it was going to offset all of your 2019 income, it cannot do that. It can only offset 80% of it. If you had losses prior to 2018, though, NOLs that are carrying forward, those are not limited to the 80%. They can still offset all of your income. So you use those older losses first before you use your 2018 loss. Entertainment expenses are no longer a deduction, so keep that in mind. Business meals are still allowed at 50%. Parking and mass transit benefits you provide to your employees are no longer a deduction. They're still tax-free to your employee. Moving expenses are no longer a tax-free benefit to your employees, so they end up on your employee's W-2. It is deductible by the business, but again, it is now a taxable benefit. That used to be a tax-free benefit prior to 2018. So we've seen some questions about that. Also want to point out, if you're a C Corp and are using the accrual basis because you had to, you now can switch to cash basis if your income is below 25 million. That threshold used to be 5 million. So a lot more C Corp taxpayers who would rather use the cash basis method can now switch to it if they like. And generally speaking, we find from a tax planning perspective, it's easier to do planning when you're filing your taxes on a cash basis versus accrual, because you have some flexibility on potentially sending out invoices or paying expenses, things like that. So now I want to cover a couple of slides that just are some general ways to reduce income or reduce your taxes. So if you are an employee that has a 401k or 403b and you haven't set up your regular monthly or paycheck deferrals to max out your 401k or 403b contributions, then, and you're expecting a bonus, then you could just make sure, you could defer up to the maximum, which in 2019 is $19,000. For people under 50 and people 50 and over, you get an extra $6,000. So the most you can put in your 401k or 403b would be $25,000. So if you're not on pace to hit those limits, then you could reach out to your HR department and try to put some more in, or if you're going to get a bonus, maybe put enough in to at least get to the max. If you are self-employed, maybe for the first time, or have never taken the home office deduction before, you should look into that. If you use a dedicated space in your business for that activity, then you can qualify to take a home office deduction. This used to be available prior to 2018 for employees where their employer didn't offer them an office space. But that was a 2% miscellaneous itemized deduction. And as David mentioned earlier, those deductions are no longer allowed as an itemized deduction. So the home office deduction really is only available for people who are self-employed, or whether that's through a partnership or a Schedule C. We just spoke about depreciation, buying new fixed assets. So with the current generous bonus depreciation at 100% and 179 thresholds at $1 million, there's plenty of incentive to go out and buy new fixed assets, or even used ones that are new to you, but they could be used and you could still take the bonus or 179. So that's a good way to reduce your income. If you're using your personal automobile to run errands for the business, and never taken a deduction, then you can get a mileage deduction for that. And again, that's available for those who are self-employed or have some sort of self-employment income on their return. Retirement plans for self-employed, SEP plan is very popular, and you can open that even next year and make a contribution all the way through the extended due date of your return, up to basically 20% of your net business income on your return. So these are very popular with our Schedule C self-employed clients. And again, you don't have to set it up before the end of the year. You can do so afterwards. We generally wait until we have the return done so we know what the net income amount is, and let the client know what the maximum amount they could put in, and then you can put anywhere between 0 and the max, again, up until the extended due date of your return. So it's a very flexible way to get some money in tax deferred. And for your cash basis taxpayers out there, again, you can accelerate expenses by, if you making sure you paid all of your bills that come in December, or maybe prepay some for January, or if you have the ability to defer income, then you can maybe delay sending out some invoices at the end of the year so that you collect the money in January rather than December. And you can manipulate your income a little bit that way. So that's something to think about. Some other ways to reduce income is that if you turned 70 and a half this year in 2019, at 70 and a half is when you are required to take your first required minimum distribution from your IRA or other qualified retirement plan, but you can elect to defer that first withdrawal until the following year. So if you turn 70 and a half in 2019, you can wait to take that first RMD until up to as late as April 1st of 2020. That would mean in 2020, you'd be required to take 2 RMDs to required minimum distributions. So, that may work out though, just, it's just something to think about depending on what your expected income level is in 2019 versus 2020. Maybe if you retired in 2019, but had some wages in 2019 and you expect 2020 to be lower, then pushing that RMD to 2020 when your overall income is lower could save you some tax. Another thing to think about is if you have some investments that are appreciated and you want to sell them, to kind of lock in that appreciation, or maybe you need the cash to cash them out anyway. Make sure you've held them for more than a year in order to get that long-term capital gain rate treatment. David had mentioned the rates earlier, anywhere from 0% to 20%, plus the 3.8 in net investment tax. So the highest rate could be 23.8, but that's a lot better than 37. So if you're looking to sell something and cash some things out, then if it's kind of on the cusp and could be long-term between now and the end of the year, wait till it becomes long-term before you sell it. If you happen to already have gains, so that's not your problem. You have plenty of capital gains, and maybe have some dogs in your portfolio. Reach out, talk to your investment advisor, and maybe sell some things that have losses to offset your capital gains. You can also take up to $3,000 in net overall capital losses against other income on your return. So maybe you're kind of in a position where you don't have any yet this year, capital gains or losses, but you do have an investment that's not doing that great and could use a $3,000 deduction on your return for the loss against your wages or other income. And it's otherwise a good idea, then you could sell it and use that $3,000 loss to offset other income. If you have unreimbursed business expenses, say for a partnership or LLC business, then make sure you're claiming those on your tax return. There's a way to do that. Generally, the partnership agreement needs to speak to the fact that you're expected to have business expenses related to your work in the partnership that they're not going to pay for. So assuming that's the case and you have them, make sure you are reporting them. And that could also be some mileage on your car, again, as mentioned on the previous slide. You can contribute to your IRA. Now this is deductible in certain circumstances. If you're in a situation where neither you or your spouse are participants in a qualified plan, then your contributions to your IRA are deductible. If either one of you are participants in a qualified plan, then there are income limitations to whether or not your IRA contribution is deductible or not. And generally, the phase outs are between 100 and 200,000. I don't have the exact amounts off the top of my head, but just keep that in mind. And you have until April 15th of 2020 to make an IRA contribution for 2019. So as part of your tax return prep process, you can look to see if whether or not you can make a deductible contribution and make a decision at that time. If you're a person who now finds themselves taking the standard deduction because of the increased amounts that David spoke about, but are interested in giving some money to charity, but realize that you wouldn't get a tax break for it and still want a tax break for it, the one way to do that is you can donate your required minimum distribution if you're above 70.5 directly to charity. And then this basically makes the distribution not taxable on your tax return. And therefore, as a result, you get a deduction for the full amount. So this also works well if you could maybe get a deduction for part of it, but not all of it, because you maybe have 10,000 of itemized deductions, but you're getting a $24,000 standard deduction. So you want to make a charitable contribution but wouldn't be getting the full benefit. You could just say, hey, I've got a $20,000 RMD I've got to take out between now and the end of the year. I just send that to charity directly, and then I get the full tax break for it. And I still get the full $24,000 standard deduction. So that's something to think about. And don't miss out on any of the common tax credits for childcare and for education. Childcare, there's no taxable income or AGI limit on that. Education does have income limits. Again, usually that your ability to take an education credit phases out once you get above 180,000-ish of income on a joint return. But if you are within the phase-out range or below it, make sure you're taking advantage of the education benefits that are out there.
Great. We've come to our final polling question of the day. Which statement best describes how tax laws impact your behavior? A, the potential tax outcome is at the forefront of my mind. B, I only think about the impact for significant events. And C, it doesn't. Why worry about them? Please take a moment to answer that. While participants are submitting their answers, I'll provide the final CPE word of the day, which is plan, P-L-A-N. If you want to receive CPE credit, please continue to jot these words down because you'll need them for the survey directly following the webinar. Again, the final CPE word is plan, P-L-A-N. Before we wrap up today, we wanted to take a few minutes to answer some questions that have been submitted online. The first question is, can you talk more about why donor advised funds are useful for tax planning? David or Troy?
This is David. I'll go ahead and take that. So the donor advised fund is very helpful for tax planning in that you can get that larger charitable contribution the year that you make the contribution of the donor advised fund and take advantage of the itemized deductions in that 1 year. And then you can dole out that money over several years by advising the donor advised fund where you want that money to go. So you kind of get your, you can get your cake, eat it too. And it's a very, very valuable tax planning maneuver. And we have many clients that are taking advantage of the donor advised funds now. You can do those through Fidelity, Vanguard. I know the Greater Washington Community Foundation will set up a donor advised fund for you. So there are very, very many options how to do that.
Great. Second question we had was, are investment fees paid to brokers still deductible under the new tax law? So
this is that section that I talked about where it was miscellaneous itemized deductions, which used to be a 2% category. You could deduct all expenses above 2% of your adjusted gross income, and that area got thrown out. So investment fees are no longer deductible. And many of our clients pay, I hate to say it, but thousands of dollars for investment fees each year, and they are no longer deductible.
Good. And one final question. Can you speak more to the idea of bunching your charitable contributions and any potential benefits to doing so?
Yes, so similar to what we talked about with the donor advised funds, by bunching your contributions in 1 year, let's say you normally give $10,000 a year to charitable entities. If you on December 31st spend the $10,000, but also if on January 1 you're going to spend $10,000, push that $10,000 that you're going to pay on January 1 back to the prior year. So you end up with $20,000 of contributions in that 1 year. So that you can deduct that whole $20,000 in, say, 2019. And then for 2020, you would claim a standard deduction and not make any charitable contributions. So that's what we refer to when we're talking about bunching contributions.
Great. Those are all the questions we've received. If you have any additional questions after today's program, please go ahead and reach out to us. Our contact information appears here on the slide. With that, we'd like to thank everyone for attending today's webinar. We encourage you to follow up on social media with @GRFCPAs and visit our website at www.grfcpa.com for upcoming events and alerts. Please remember to complete the emailed survey that follows if you would like to earn CPE credit for attending today's webinar. Thank you again for attending and have a great day.